we work with, and they tell us what barriers they face when they were trying to grow their business, whether it was with marketing or trying to access capital. Different institutions really exist so that other small businesses can learn from their own experiences and it can be more relatable to them. But yeah, going to start off with the main focus on this presentation, which is the 5 C's of credit. So 5 C's of credit is honestly really, really important for anybody who's trying to access some type of loan or capital. So it's not just for a small business loan as we're discussing today, but it's also when you're trying to get a home loan or you're trying to get a credit card or different types of financing. These are all things that we're going to that the lender will be looking at. So we're going to be basing our decision, all the information that we collect on the 5 C's of credit. So I'm going to be covering this presentation. What is each of these C's? So character, capacity, collateral, capital, conditions. How does the lender look at it, and how you can prepare for looking at these C's once you want to apply. So the first one, character, is probably one that we're most familiar with, most of the public, and that is because this is connected to credit, personal credit score, your FICO score. As you know, anytime we try to open up a credit card, anytime we try to open up get a loan, they're going to want to run your credit so we can know, how your history, if you're making other payments on time, what accounts you have. So character, what the lender is trying to assess here is the willingness for the person who's applying, so the business owner in this case, willingness for them to repay back the debt. So how responsible are they? How much do we know about the person who's applying here? It's not just credit alone. We also going to want to ask more in-depth questions here, which because you're the business owner, we're going to want to see how much experience you have in your business. How long have you been operating? Before the business, what was your experience within the industry, perhaps? And the last one here, it refers to tax history. So tax history is actually part of how we assess the business and yourself as the owner. So are you doing all the documents? Are you filing taxes every year? Do you have all the correct license permits for your business? Because obviously you having all the documents and keeping in check with doing the finances tells us that you're taking well care of your business and you are responsible on that end. So I'm going to break down first a little bit more about what credit is composed of. As many people know, this number, every individual has a credit score, but many people don't know really what it's composed of, what affects it. So I'm going to be covering a little bit more how you can, take more note of your credit score and how you can be taking care of it before you apply for any form of financing. So if you aren't sure what your credit is like, the first step I would tell you is to either go on this link here. Every individual has the ability to get 1 free copy annually if you go to the website here, www.annualcreditreport.com. And there's also other apps that exist. Even bank apps at this time have the ability to integrate being able to check your credit. So there's different ways you can get that information if you're unsure what your credit is like. But the range of credit is from 300 lowest to the highest of 850. So what is the number composed of? And one other thing is that there does exist 3 different agencies. So there's Equifax, TransUnion, Experian, and typically these punctuation, like the credit score will vary by a few numbers. But typically a lender might use maybe one agency, maybe they use all 3 to assess everything. That's something you can ask once you try to speak and get information about the process. For TMC Community Capital, we will only run Experian, so we will only use your Experian credit score. But what is this credit score made out of? What affects it? The highest percentage of the credit score is going to be at the 35% here is payment history. As you guys are well aware of, anytime you maybe miss a payment on a credit card or an auto loan that you maybe have, a mortgage, say you're 1 month behind, that will negatively affect your credit score. So it will bring your points down versus if you are on time with every account on your credit cards or different, perhaps a line of credit, that will positively affect you in the long run. So payment history really just it's straightforward. It's making sure that you're making your payments on time, that you're on track with everything. This will ensure that you're keeping good with your credit. And the second component that is the largest here is at 30%. 30% here refers to debt to credit utilization. So debt to credit utilization is actually a percentage that appears on every individual's credit report, which tells us how much of the credit is still available to use. So, example, if somebody has a combination of credit cards with a total limit of about $50,000, and we see that they only have a percentage of availability about 5%, that tells us that the individual is depending a lot on their credit cards, that their balances might look anywhere from 40,000 to above. And so they only have 5% of credit available to use. So that is kind of a little bit, shows a little bit financial distress to a lender. We want to make sure that people are not depending on credit cards, especially with the interest rates, but knowing how to manage them well. So kind of like a word of advice, typically we want to make sure that you are only using 30% of your credit cards combined, so that you're leaving 70% or 60 to 70% available to not be used when we run the report. And the third case here is 15%, which is credit mix. This one's also pretty straightforward. It just will tell the lender what types of credit accounts does the individual have. So on credit report, there's 3 different accounts that it can appear. The first one being a mortgage account, that's any home loan that you may have. The second is any installment loan. So installment loans, it refers to type of financings where a set amount is paid monthly. This refers to, auto loans that you may have. Student loans also appears under this section. And then a business loan. This is where if one of our clients, this is where we would be reporting. And the last section here is credit cards. So we want to make sure that individual maybe is using they have different types of account. They not just have credit cards. They maybe have like a small personal loan that they have, so that they have history in trying to build their credit on the mixture of accounts. And the last 2 here refers to credit history. Really 10%, and this is how long do you have building your credit. As we know, if somebody just opened their first account, it's going to take them time to build up and get a higher score, versus someone who has maybe 30 years already building their credit. They have more probability of having a higher score if they have been responsible. And then the last portion here, the other 10%, is going to be new credit. Anytime an individual applies for any form of financing or credit, say for trying to get a business loan with TMC, or trying to get a credit card with your local bank, or trying to get a mortgage, the lender's going to have to run your credit. So going to have to run it through Experian or Equifax or TransUnion. And running the credit is going to negatively impact you by a few points because you're applying for new credit here. So that's something else that you should take into account when you're trying to apply for financing. So there's a difference. One important thing that I'll note here is a lender can either do a hard pull or a soft pull. A hard pull means that they will be getting the entire report and this will be affecting your credit score, versus a soft pull, it will just be like a glimpse, so it will not be affecting your credit score. So that's something you can also ask the lender. Are you guys doing a soft pull or a hard pull? And that is credit. So the second part of character here is what I mentioned, trying to get more information about the individual, the owner of the business, how much experience they have, how long they have been operating, as well as addressing any issues that they may have with credit or financials. Building a relationship with a lender or a banker is really, really important, and honesty is key here. There's many times where I, speak with someone who's interested in applying with us, and I ask them, how does your credit look like? And they tell me, oh, it's great. And then we run credit and, it's not, they have delinquent cards, like late payments, and it's more difficult for us to bypass that, because it's better for us to know up front if it's something that we can or can't do. And now they're also being negatively affected by the fact that we ran the credit. Versus someone who tells us, I had this happen, so you should be expecting to see this or this or that. And so we're going to be ready to, see that when we run the credit and accept those explanations, because we can be flexible, and I can explain how we're flexible with credit towards the end when I talk a little bit about our programs. But same thing for financials. Tell the lender up front, or a banker, what what's going on with your business, maybe why your credit was affected, so they can tell you there and there if it's something that they can work with, or maybe they, if it's not, they can refer you to someone that can. And another very, very important point that I will make here is anytime that you are applying for some form of capital, especially a loan, come with 2 points of information ready. One, how much you're looking for, so the exact amount, and two, how you're trying to use the funds for. We want to make sure that the owner of the business comes to us with a set plan of how they think their business is going to, grow from this capital that they're seeking. Are they going to get inventory? Are they going to hire an employee? Are they going to refinance debt, with high interest, so that they know, they're coming here as an expertise of the business, that taking on this loan is going to be an investment for their business in the long run. Because as an example, in the counterpart, I speak with some people when I ask this question of how much you're looking for, and they say as much as I can get. That's honestly pretty like a red flag to us, because it shows, they're just trying to get the money and they're not really sure how they're going to use it. It's just trying to get as much as they can obtain here. So it's better that you have a set plan. As well as if you're trying to do a bigger project, say a business expansion or an acquisition, and this is going to be more funds than maybe the loan itself is going to be. So maybe you're trying to expand a business and it's going to cost $70,000, but the lender can only provide $50,000. The lender is going to want to see, where are you going to be attaining the additional $20,000? Is it going to be from maybe your savings account? You're getting the personal family loan. We want to make sure that the entire project is secured, so that it's not, we don't just give you the $50,000 and then you can't even complete the project because you were not able to attain the additional $20K. Yes, that is character. I think it might just be because it's a lot of information. If anybody has questions on that first C, feel free to stop me here and then we can cover it. Or you can also save it towards the end. But because it's a little information, I can totally understand if you want me to explain anything. But, if not, I can move on with capacity. So capacity is the second C. Here is probably the most often reason why a lot of small business owners get denied. And so it's actually when we're looking at the finances of the business. So this is where we look at, if you're a startup, we're going to be looking at business plan, projections. So what you have is set in mind to open your business, how much you believe your business is going to grow with this additional capital that you're seeking from the lender. Versus a business that is already established, they've been operating for maybe 1 year or 50 years. We're going to be looking at their cash flow. So cash flow here refers to what we see on bank statements and tax returns. So we're looking at how much money is coming in, income, so how much revenue the business is making, versus debt, how much is going out in expenses. So you want to make sure here what we're trying to assess is that the client has the ability to repay debt. How do we do that? Ensuring that the business is making more money than it is withdrawing. So that is what we refer to positive cash flow. This is often known as a debt service coverage ratio. So we just want to make sure that the business is making more revenue and that it is being deposited, being withdrawn every month, because if not, it's going to show, slowly the business is going to be making less money and eventually might not be able to afford to take on this loan. So really what we're trying to assess here is just that it's responsible on our end to be able to give this capital or this loan to the business, and it's going to help them, grow their business rather than put them in a spot where it'd be difficult for them to pay the loan. So I will say this upfront. So we actually, our organization only does established businesses. We do require businesses to be at least 1 year in operation. So we will ask for financial statements. We don't do business plans or projections, but we do work with other partners that do so. So if you do have a startup, the typical documents are going to be like the ones I mentioned before. The business plan that showcases, what you're trying to do, your experience, how much is you're seeking, how is that going to benefit the business, and then financial projections. So how much you believe your business is going to grow from the capital. And this is something that you can also get created if you're unsure of with a business consultant that they can help you with. But I'm going to be covering for established businesses. So for established businesses, there's 3 forms that I mentioned. There's 3 types of documents that we're going to be looking at. The first one being tax returns. Tax returns is we're going to be looking at if there's a net loss, meaning that, there was more expenses than revenue being made. We're going to want to ask the business why. Get an explanation from them. There's many cases where, because business owners don't want to pay tax, they tend to underreport profits or revenue and then overreport expenses. This is often a case, which is why our organization actually tends to depend a lot more on bank statements rather than tax returns, because we know maybe it's not often the most accurate financial document. Some other thing that we also do is if there's any one-time expenses in the tax return, say a restaurant had to buy, this equipment that was $50,000. So we know that that equipment is not going to be bought annually because it's going to, last 3 years. So we can add back those $50,000 to the revenue instead of taking it as an expense. So we can help their cash flow and the assessment of it. Lastly, what we're looking at here in tax returns is the breakdown of ownership. The reason why we look at ownership is because typically with any lender, anybody that has more than 20% ownership in the business, it's going to also have to be included in the application process. What that means is that we're going to also have to collect maybe their personal tax returns, have a form of identification for them, and also run credit. That's something that I want to pinpoint. In many cases, it's very important that you take note who you are running the business with, because their credit score might also affect your application, status. So it's something to also take into account here. And then the second document is a profit and loss statement. Currently, we are requesting 2023 profit and loss statement if the taxes for 2023 have not been filed. And the reason is because honestly, a profit and loss document shows similar information. So it shows both the revenue being made, expenses, and then how much profit is being left towards the end. It's just more of an unofficial document. So here we're going to be comparing it to the bank statements. Are you making the same amount of money that you're stating in this document? And similar, we add in the expenses that were only one time, and they can help your cash flow. But getting into the bigger portion here is bank statements. Bank statements is key to our organization. This is where we're going to be assessing cash flow for every month. So looking at how much is being deposited, in comparison to how much is being withdrawn. Is there any negative ending balances? Is there any non-sufficient funds? So we're going to want to be taking into note those different points. So it tells us more information about how the business is operating, how the financials look. Something else is that if there's any large deposits, say there's 1 month, typically average revenue is $10,000, but there's 1 month where the business made $30,000 and we see it was because they got a high deposit. We're going to want to know what the high deposit is. Sometimes it's a loan, sometimes it's a grant, and we can't include that into the cash flow because it's not business revenue. It's just money that they are receiving outside of that. Ooh, and then lastly, I want to share the importance of cash. So there's a lot of cash-based businesses today, and what that means is that there's just a lot of businesses who get their money in cash. That's a high percentage. This is like beauty salons, restaurants that you go where there's street vendors. And because they get their money in cash, most of the revenue in cash, they tend to maybe not deposit everything into a bank account. And so that's just how they're used to operating. They don't really see a problem with it. But until they, are trying to apply for financing, that's where it does become an issue, because they can tell us they're making, or they can tell a lender they actually make about $15,000 monthly, but they only deposit $5,000 because they use the rest, pay their employees in cash or buy in, inventory in exchange. And so that does tend to be an issue there, because a lot of lenders can't really, it's hard for them to take the word of saying, yeah, I just keep it at home, or, I just don't deposit it, because it's difficult. They need to see it on physical paper. So we always do advise to deposit all your cash, especially if you are preparing to get a loan. Our organization can be flexible just because we tend to think, as the first stepping stone to eventually trying to grow your business. So in our application, we can accept stated cash. So if it's, within the industry, say like a beauty salon or restaurant, and they make a certain percentage of it in cash, we can ask them how much do they make monthly and take that into account for the cash flow. So any money that they're not depositing into a bank account. Similar as well if maybe they're using other platforms to collect their revenue. So if they're using perhaps the Venmo or Cash App, and they can deposit it in, and we can take those statements to also take into account. Yeah, was there a question? Okay. So that was capacity. So this is how we kind of assess how much the business is, if they have ability to repay back the debt, and why the financials here are important. There's no questions. I will move on to Collateral. So collateral, here's the third C, and this refers typically as a guarantee or extra security that the business owner can add onto the loan to make sure that they can attain that capital. So this is more typical for higher amounts of loan. An SBA loan is very common, and so there's different forms that a collateral can be seen. An automobile, if you're the owner, if you have the title of it, if you're of your house, maybe a certain equipment that you have, certain merchandise, or even an invoice. So as an example, sometimes a lender may ask you to put down the title of your car in order to be able to access a $50,000 loan. So you can present that to them to make sure that you secure it, or maybe if you know you don't have the best credit, this can guarantee or ask security so that the lender kind of has a incentive to want to provide you the capital, because you're showing that you're willing to put down your card because you believe in your business and you know you're going to repay back the debt with the loan here. So it's the collateral is pretty straightforward. Not every lender will require it. This is often a question that I would pose that you guys also ask to a lender if they require collateral. Perhaps you do not have any collateral to put down, which is fine. It would just be finding the lender that does not require it. Our organization, for example, does not require collateral just because we tend to do smaller amounts of loans. The only case where we do require it is if the business is trying to get a business vehicle or a food truck. We would take that vehicle that they're purchasing with the dealer as collateral until it's paid off. So that is the third C, and we can move on to the fourth one. The last two are a little bit more simple to cover. But the fourth one here, capital, is a lot more important for startups. So if you're a startup, I would pinpoint you to kind of take this into account. So capital here refers to capital injection. So how much money have you put into your business from your own? How self-funded are you? Typically, when you come to a lender, they are going to ask you to have all those, if you kept your receipts when you bought this certain equipment, or maybe all the permits you get to formalize the business, make it into a corporation. It's very, very important that you do keep track of any money that you personally spend from your own funds, from your own maybe W-2 or outside income to the business that you're trying to start. Because the lender is going to want to make sure that you have provided sufficient investment in the loan to get the business to be able to acquire the loan that you're seeking. Typically, I would say it depends on the lender, but a lender might ask you to be between 20 to 30% of investment or injection into the loan in order to secure it. I'll give an example because I know it's a little bit maybe perhaps difficult to understand, but if a startup business is trying to acquire, say, $100,000, to get going and grow their business and maybe attain the equipment that's needed or the inventory, the lender might ask them to put 20% down payment in order to secure the extra $80,000. So this can be maybe perhaps from the self funds that they have. Maybe they have savings, or it can also be money that they already spent from their, those receipts that they did to formalize the business. So it's a very important point for startups, because you don't really have the financials to show that you've been operating. So this is where we're going to be the lender's going to be measuring how secure or well-known you believe in the business. And the last C here is going to be conditions. Conditions is something that you can't really affect in itself. It's just something that the business owner should take into account and maybe research into. So conditions refers to general economic conditions related to the business you have, or I would even say industry here. So it refers to looking at the industry, how the economy is doing, and the experience that you may have. So I'll give an example here to kind of assess what I mean by conditions. And we always state this one, but if during COVID, if a restaurant came to a lender and said, I'm trying to get $50,000 loan, it would be very difficult for them to attain that capital because all restaurants were closed. Nobody was going out, getting food. And so the lenders were a lot more restrictive on restaurants, and they were really not borrowing money to that industry. So that's just one example, taking into account how maybe your industry is currently being affected by different types of conditions, and maybe even asking the lender, are you currently maybe lending to trucking industry? I can tell you right now, due to the economic inflation, trucking and construction industries are being a little bit more affected. So many banks and lenders are being more restricted to those industries, and you can kind of push to them or ask them how am I being affected. So for example, if a trucker or trucking business came to me at this time and was interested in applying, I would have to tell them that they would not be able to apply for anything above 25,000 unless they had collateral. So that's just one point of case, one example of how a lender may be more restrictive due to how the economic conditions are doing, and why you should also maybe get more knowledge on those certain cases so you can prepare when you should apply for that capital or who you should be applying with that capital for. And so those are the 5 C's. I know that's a lot of information, and I can also share over these slides so you can kind of keep a note, and maybe if you're not even looking to get financing right now, but just trying to get this knowledge for the future. But here's some recommendation that I can kind of pinpoint you to. One, obtain all the financial documents that you're going to be needed to apply. I would say step 1 is speak with the lender, ask them upfront what their process is like, what documents that they're going to need. As you know, if you're a startup, it's going to be different versus an established businesses. So just get all the documents ready so that the process can be a lot more easier versus, they tell you they need something and then you're kind of like going back and forth because you don't have that document. And second point is just like I mentioned, learn what your credit score is. And if there's any issues on there, maybe a charge off or, a collections account, resolve it before you apply to lender, or maybe just tell the lender upfront as well if it's something that they can move forward with. And third, I also covered too, but really, really important, deposit all the business revenue, including the cash that you're making, into your bank account, because it's going to be much easier for you to get approved if you are depositing everything and we can see that cash flow on paper. And lastly, always ask a lender what their interest rate is. This is a great way that you can compare what is the best option for you, as well as APR. So the best way is to compare APRs. Whoever has the lowest APR is going to be, you're going to be paying off less interest before accepting any loan. And the reason why we kind of really pinpoint this last point is because there's a lot of times where business owners, get emails or they get calls, and there's somebody telling them, oh, we have this loan and it's so easy, you can get it, in a few days, we'll ask you for little information. They make it so easy, but then it's going to put them in a really difficult spot because they don't look at the interest rates that they're putting in. I've seen about up to like $30,000 of interest rates, and that puts actually in the long run the business owners in a difficult situation, especially if they're an MCA. So that's just something that you should always ask for lender before you sign any documents, even before you start a process perhaps. Ask them what their interest rate, if it's fixed as well, or it's based on the prime rate variable. So you can have that information ready. And so that suffices to credit. That's how you can prepare what information you should be taking into account when you want to apply for a loan. I'm going to be now covering a little bit about our organization. If you are interested in applying, perhaps now or in the future, these are things we take into account. So 1, the business does have to be for profit and registered in the state of California. 2, they do have to be in operation and generating revenue for at least 12 months. So like I mentioned, we just don't do startups, but we do work with other lenders that can. So I can always refer you out if you are. We have certain excluded industries like entertainment, cannabis, rideshare, speculative, which refers to crypto, real estate, and those sort of. Then other point is we do not have a minimum FICO score to apply. So one thing I also will point, when you ask along with the interest rate, also ask the lender if they have a minimum credit score that's required. In many cases, they might perhaps, if it's 650 or above, or that's when they can apply. So you can know if that's the right fit for you. Our organization doesn't have a minimum credit score. We tend to look more on the entire report, especially focusing on the most recent 2 years. That's the time span that we're going to be looking at. We can ignore medical collections, student loans, any utility collections as well. And if there's like any 1 or 2 late payments, we can continue with the process with explanations. especially if there's any delinquent accounts from the duration of like COVID, 2022 or 2021, we can just accept that time. We know a lot of businesses and individuals were affected during that period, so we can, just move forward with the process. And we also accept ITIN holders too. But these are our loan products. Really, here on the right, we have two different products that we offer. The first one being the Microloan Lite. This is for any loan from $5,000 to $15,000. The interest is 7.5 to 8.5 fixed. And our interest is always going to be tied to the term of the loan. So how long you have to repay it. So if it's anywhere from 1 to 2 years, it will be at the 7.5 versus 3 years, it will be at the 8.5 interest rate. And the documents that are required for this first product is just going to be 3 months of bank statements. So that's all the financials will need, just 3 months, along with a proof of business and form of ID. So we created this first product, make it a easier process, really minimal documentation, rather, having a lot more that may be required from other lenders. But the difference when we go to the second product here, being the microloan, this is for any loan above 15 all the way to the maximum that we offer of 50K. The difference is that in addition to the 3 months, we're also going to require 1 year tax returns here. So we would need 1 year tax returns here, and the interest does go up to 10.5 fixed, because we can also offer higher terms up to 5 years. So here, 5 years will be at 10.5. And one thing we're always very, very transparent on is that we do have a 5% processing fee. What that means is that for whatever amount a business owner is approved for, that being, 5,000, 25,000, or 50,000, 5% is taken out from those loan funds itself. It's nothing that they had to pay out of pocket, and they will be receiving the remaining into their account wired. But yeah, that is a little bit about how you can prepare to get a business loan, what points to kind of take into consideration, whether it's now or in the long run, how you can prepare, and a little bit about our organizations as well and the products that we offer. This is my information here. If you are, would like to reach out or have maybe a question about something I covered here, wanting it to be more broken down, feel free to reach out to me. You can definitely do a call. But at this time, is there any questions that you guys may have, whether it's about our products or about the 5 Cs?
Hi, this is Laurie. I have just one question. Well, 2 questions. One is, can you pay off the loan early without a penalty?
Yeah, that's a great point. Yeah, you can pay it off, and we do not. There's no fee to it. That's a really good question as well. So when you're applying for a loan, yeah, ask the lender if there's any prepayment penalty fee.
Okay. And then on the conditions related to our industry, how do we present that? Is that a question on the application? Do we have to kind of provide?
This one's difficult because it's not really, like I mentioned, something you could affect. It's not even something that the lender is going to have on their application. It's really just paying close attention to maybe how your industry is currently being affected, how the economy, and taking that into mind. The only way I could really tell you is asking the lender, are you lending to the restaurant industry? Are you lending to the trucking industry? And they can tell you more so how maybe restricted they're being, how they're currently handling it.
Okay, thank you very much.
Of course, thank you as well. There's another question.
I wanted to say thank you very much to begin with for the presentation. It's a lot of information, but great information. I do have a question about when you were saying, the microloans. You guys only do microloans, which is up to 50,000. I don't know, do you mentioned something about referring to other institute. Are those banks or similar to you guys?
So we, as a priority, typically do CDFIs, so institutions like ours, nonprofits. There also are nonprofits who do higher amounts, so they can also do startups. So in case what we can do, they can do. So yeah, we can already refer you over to those organizations. If a business is ready for a bank, meaning they have perhaps all the documents, their cash flow is doing well, they have great credit, we can also do that too.
Okay, but let's say for a business that it's already up and running, like 2-3 years or whatever the time. And, the person needs maybe 70,000, 80,000 or something like that. So you will not do the 50,000 plus the 20 or 30. It will be that institution doing the whole the
Yeah.
entire amount, right?
Yeah, what you're referring to or you're asking is called stacking a loan. Stacking a loan just means when you get a loan from one organization and then another to cover like the we can do that, but it kind of has to be presented as to the lender.
Right.
And how we kind of assess that is that the business has the ability to pay both of those loans. So taking into account our monthly payment and the one that they're doing. So if that's what the business owner is seeking, we can do that. But typically I would start off by referring them to a lender that can do the entire $70,000 because it makes it way easier for them to just have one single loan.
Yeah, and that's what I was thinking too, but I wanted clarification. And then the interest rate, do you think is about the same, the 7.5 to 10, or maybe a little bit higher?
It would probably
Because of the amount.
be around the same time. There's I do not know the interest rate of honestly every institution on here, but as a CDFI, I would say they have to be responsible on there to not have high interest rates.
Okay, well, thank you very much.
Of course, thank you. Great question.
Can you put your contact information one more time?
Sorry, I think I exited. This is my email and my number. If you call me and I don't answer, feel free to send me a text. Sometimes I'm just out on an event. So
Thank you.
any other questions? I'm good. Like I mentioned, I can also share the slides because I know this was a lot of information to kind of input. And if you guys do have any questions, you can also reach out.